Okay, welcome to the Forex Education Series. What we're going to be looking at today is an introduction to money management. Proper money management is possibly the most important ingredient to becoming a successful Forex trader. If you don't fully understand the implications of money management and how to implement these techniques, you have a very, very slim chance of becoming a consistently profitable trader, and it's highly likely that you'll probably blow your account. Rules of good money management: risk no more than 1% of your capital. So for new traders, small amount, risk no more than 1% on each trade. Why is it so important? The main idea of the whole trading process is to survive. This is the most important part of the lesson. Survival is the key. You've got to be thinking about protecting your capital above everything else. Then you think about making money. The money will come later, but if you put making money first and survival second, or protecting your capital, you're going to blow your account. So put that in the back of your mind, that survival is your key to trading. And what does survival mean? It means good money management and protecting your capital. Okay, this is just an example of what will happen with various drawdown scenarios. You have a $10,000 account with a 10% loss. Your new balance would be 9,000. You would need 11.11% gain just to get back to break even. If you take a 25% loss on your new balance, you would need to make 35% just to get back to break even. So what I use as a rule of thumb, you need to keep your losses below 25%, because once you get to this 35% gain, it starts getting increasingly harder to actually get back to that break-even level. If you keep your losses small, it's still manageable. Right, so once you get to a 50% loss, you actually need 100% gain to get back to break-even. And then when you get to 70 and 80%, it becomes impossible. I mean, a 200 and 400% gain, you're not going to make that, and you're more than likely going to blow your account. So as you can see, the main thing here and the main lesson is about survival and protecting your account. You'd rather want to be sitting with a small gain at the end of the month than a fluctuation of your account where you're doubling your account and then losing 30 or 40% and so forth. Rather have small incremental gains with low drawdowns. A little bit about risk versus reward. Here is a typical trade setup with a pin bar. You'd place your stop loss below here, so you'd be getting in around this level here. Your risk portion is this portion over here. So essentially what you're looking at is, in order to be a long-term successful trader, you need to be having a risk-reward ratio of around 1 risk to 2 and possibly 3 or above. So these larger returns will protect those smaller losses that you take. Interesting exercise here. Most traders that you talk to will say, what is your hit rate? I.e., how many out of a certain number of trades, how many are you profitable? And the higher that number, the scenario is that you should be a more successful trader. But that doesn't necessarily always work out. And here's just something to think about. Out of 25 trades, you can take 18 trades in a row, losses, and still come out with a positive result. That's 72% of the time you're going to be wrong. All right, so here's the maths. If you're risking $100 per trade, 18 losing trades is $1,800 loss. And it's highly unlikely you're going to take 18 losses in a row. But this is an extreme case. You then have 7 winning trades, but your risk-reward ratio is 3 times. Okay, your reward is 3 times your risk. So for each of those 7 winning trades, you're now going to make $300. All right, $300 times 7, $2,100 less your losses that you've taken. You're now sitting with a net profit of $300. So the whole thing is that you don't know when these losing trades are going to come, and they can come in quick succession. If you're practicing bad money management, you will blow your account. I assure you that that will happen to you. So always be consistent, use the same amount for each trade, and follow your system, but most of all, use good money management, because the good trades will come, just as the bad trades will come as well. So trading is a marathon. It's not a sprint. The way you win the marathon is through consistent implementation of risk reward combined with a mastery of an effective trading strategy. Position sizing, it's the term given to the process of adjusting the number of lots you trade to meet your predetermined risk and stop loss distance. So the first thing you've got to consider is where to place your stop. Okay? And what is the amount that you're comfortable with when placing that trade? How much are you comfortable with losing? Okay? What is your pain threshold? And then you can either use a fixed amount of capital, or you can use a percentage of your capital. So you look at your charts and you decide where you're going to place your stop, with using your various technical setups, etc. But what you should never do is place your stop too close to your entry or at an arbitrary or any arbitrary position, just because you want to trade with a higher lot size. That's called greed, and I can assure you it will come back to bite you. You then enter the number of lots or mini lots depending on your account. That will then give you the dollar or percentage risk that you've decided on and that you're willing to risk. Rules. Very, very important. Never adjust your stop loss to meet your desired position size. Okay? Always the other way around. Adjust your position size to meet your predefined risk and logical stop loss placement. So if it's $100 that you're going to risk, that is the amount that you risk, and you change your position size accordingly. If it's 1% that you're risking, that is the amount that you risk. Always change the position size and trade the same amount. As I said, if it's $100 or $200 or whatever it is, trade the same amount each time. Be consistent with your trading and use the same amount of, or if you're using percentage risk, use the same amount. Okay, so if you have a wider stop, it doesn't mean that you need to adjust or to risk more money, right? Just the same as if there's a smaller stop, it doesn't mean to say that you need to risk less on the trade. Okay, here's an example. In this instance over here, if we'd gone long over here, the stop would have been down here. Now that's 179 pip stop. Risk $100. Okay. In this scenario over here, 95 pips, so it's a lot less than that 179 pips, but I'm still going to risk only $100. Something has to change, right? In this instance here, your position size will have to be smaller. In this instance here, your position size will be slightly larger than in this instance, because obviously you are risking less. There's less pips involved here. The more you get used to this, the more you will understand what I'm getting at. But the main thing is never risk more than that fixed amount or fixed percentage that you've decided to risk on each trade. Here's just a explanation of fixed dollar risk versus percentage dollar risk. So the percentage risk method grows your account quite quickly on a series of wins, but conversely slows your account growth after a series of losses. So it becomes more difficult to bring the account back to break even as your position size is decreased with each loss. Okay, so once your account is, if you have wins, your position size will increase according to how large your account is. But once you're losing, you have to decrease that position size. So it becomes harder to actually get back to break even. Right. Many professional traders use the fixed dollar risk method, as they are more confident in their Forex and trading and the strategies that they employ. They don't overtrade and don't over leverage, so they can safely risk a set amount that they're comfortable with losing on any trade. For a new trader, I would say that the percentage risk is possibly a better one. In this example here, we see the fixed versus percentage risk. Okay, also 17 losses, 8 wins. All right, this is just a hypothetical win-loss trade scenario, and you can see going through it here, at the end of the day, on risking the $100, the fixed risk amount, you have a $2,700 amount that you end up with a starting account of $2,000, so you made a net gain of $700. And in this instance, with the fixed 2% risk, you having a net gain of $262 from 2,000. So obviously what we're seeing here, that with the fixed risk amount, at the end of the day, you're possibly going to come out with more. But there are risks with both scenarios. There are pros and cons. My suggestion is stick with the percentage risk for a new trader, and if you're more advanced and you are confident in your trading and your trading style, then go for the fixed. So money management tools, just type into your browser now tiny.cc/mm123. It is the position sizing. Let's just say you got a $5,000 account and you wanted to risk $100, okay, and you had a 60 pip stop loss. You then click on calculate. If you risked, or you put on 2 mini contracts, you'd be risking 2.4% of your account. 1 mini contract, 1.2%. So you probably go for this one mini with a 60 pip loss over there. You can play around with that. Very good tool. Right, the next one that you click on the site there is this. It's just basically a simulator. All right, let's just say you had a 55% win-loss ratio with a payoff ratio of 2, and you wanted to see how quickly you could make 15% on your account, say your $100,000 account there. It plays out different scenarios and recalculates them. This would then, just click on calculate there. Right, the number of trades would be 3. Okay, click on it again. Number of trades 6. Okay, so the maximum percentage drawdown is 5.9% and 3.2% risk reward ratio. Okay, play around with that. It's really a useful tool. The last one is a script. This is the script over here. Just save it into a text file and save it as an MQ4 file and place it in your scripts in MetaTrader. Okay, so here we have the script. All you do is you drag the script wherever you want to place the stop. There. Okay. Choose the amount of risk. So in this case, it's 0.01 is 1%. I'm going to go with 0.1%. Okay, you put it on, and there it places the trade. All right, guys. I hope you've learned a lot about money management. Look forward to doing further training material with you. Cheers for now.